When the uranium market really gets going, it's going to make the silver move look like watching a CFL game when you could have been watching the NFL, Chris. It's
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And as we continue on in this fascinating summer, not only in the gold and silver markets, which have been a lot of fun to follow, although what's interesting is that there are some other commodities that have a similar profile to silver. And fortunately, I'm joined today by Amir Adnani, who runs Uranium Energy Corporation and gold mining and is an expert, especially in the uranium space. And Amir, I mentioned to you that I actually had a friend send me a message saying, you know, they were looking at uranium. They're like, we got to find the Chris Marcus of uranium. And I think it's interesting because that same feature that drew, especially when silver was, you know, $12, $13, $14, and you have somewhat of a floor when you're below the cost of production, similar dynamic in uranium. So perhaps for folks who might be a little new to that, you could just give them an overview of what's been going on there.
Well, you know, I think when the uranium market really gets going, it's going to make the silver move look like watching a CFL game when you could have been watching the NFL, Chris. It will be a completely different ball game, and the reason why I say that is because look, uranium has kind of the industrial components to it from the demand side that silver has, which really turbocharges. It's not just a store of value, but uranium is 100% required for power generation. So 100% of the demand profile for uranium is consumption, and it's a depleting commodity. And for too long, for close to a decade, uranium prices have been below the marginal cost of production and also the incentive price to bring new uranium mines online. You look at many of the COVID-19 disruptions that impacted uranium mines. You know, the Bank of Montreal BMO team did an analysis, Chris, to see which commodities were most impacted by fly-in, fly-out operations, because those were at the greatest risk of impact due to COVID. And uranium actually was at the top of their list of having more mines that are in remote areas. And subsequently, there's been a significant impact to production cuts this year into uranium because of COVID-19. And uranium prices are actually up 35% year to date. Best performance for uranium price since 2016. However, we're still below marginal cost of production. So uranium prices haven't made the move that would be kind of prime time. That hasn't happened yet. And Chris, where uranium is very different to silver or gold, and this is why I think the coming move in uranium will be even greater than that in silver, is due to the very illiquid nature of the uranium market. Uranium trades over the counter. It's not LME listed. It's an over-the-counter market. It's very thinly traded. And all you got to do is look at the move that happened in 2006 timeframe, where uranium prices were at around $20 per pound and driven by supply disruptions, very similar to what we're seeing this year in 2020. Uranium price went from $20 a pound to $140 a pound within a year and a half. And even you talk to this day with people like Rick Rule, and he would confirm to you that more people at Sprott and clients of Sprott, or even Rick himself, made more money in the uranium rally of 2006 and 2007 than any other commodity or run ever experienced. It's quite sort of famous in what it can do and what it's done. And I think today we have an incredibly better setup for the uranium market to really have a spectacular run than we did in 06, because today we have a much larger base of reactors operating in the world globally. Even number of reactors that are under construction globally is back above levels before Fukushima happened in 2011, which is the main event that kind of created this bear market that we're in. And you have the fact that today more than ever, there's a growing global movement of climate scientists and environmentalists that recognize nuclear power's base load ability to generate electricity around the clock without any carbon emissions. I mean, even in 2006, 2007, electric cars were not nearly a thing as they are now. I don't know what Tesla's market cap was back in '06, but it certainly wasn't over $200 billion like it is today. So there's a much stronger structural shift towards electric vehicles, towards e-mobility today. That means we need more clean electricity generation, and that's all nuclear power does. And that is simple and straightforward to understand. Yes, you don't need nuclear power and uranium to wear as jewelry, but I love the fact that it's just a straightforward energy commodity, and that supply-demand picture is really it's a coiled spring, because demand far outstrips supply. Demand is 180 million pounds a year. Supply this year, especially with all the COVID cuts, is 120 million pounds per year. So there's a structural deficit between demand and supply. Above ground inventories have to meet that demand. Above ground inventories are finite in quantity. So we're drawing that down. And as we draw it down, that spring is getting tighter and tighter. Only way to meet the long-term demand is to mine more uranium. At $35 uranium, we are half of what the incentive price is at 75 for most mines in the world. And that is what makes the picture so compelling from a pure nuts and bolts supply point of view. So, hey, no offense to the silver bugs out there. I love you guys. But uranium, could it be the next silver? No, Chris. It'll be bigger than the silver move.
I was gonna say you know how to throw a headline out there. That might be one of my favorite sentences of the year. Makes the silver market look like a CFL game. And I mean, it's interesting because, again, like you described, you have those dynamics where, I've seen it from the Wall Street side where, they're trading their thing. And I mean, I'm guessing even the uranium traders probably aren't aware of that, but you keep going in deficits. And I love the way Rick Rule phrases it, that basically either we're going to stop using electricity as a civilization or uranium prices are going up.
That's it. Either the lights go out or prices go up. And with the amount of time we're all spending at home and on our devices, all of which need electricity, prices are going up. We're not going to stop using less electricity.
Yeah, and I'm curious, you talked a little bit about what happened in 2007. And actually, I mean, again, when you look at the chart, looks kind of like silver in 2011 or 1980. You've talked about how there's an imbalance building. Of course, you get government involved, going to make everything harder to do. So one of the things, when we see a spike in some of these commodities the next time, it's like silver got to 50 twice and came back down. But I'm wondering, next time when you look at what's happening with the way everything, the currencies are being devalued, I mean, what do you see as a long-term price of uranium? I mean, do we see a spike as higher than 140, and also whatever level it goes to, does that become the new price going forward?
Well, it's an excellent question. And again, you hit on a couple of really key points. I mean, what happens to the US dollar? And of course, I expect with the trillions of dollars of printing and again, the need to continue to suppress real rates, US dollar will continue to have weakness. And that does have a relationship back to all commodity prices, not just gold and silver. And that's a dynamic that that's one of a number of dynamics we can talk about that can drive a new all-time high in the uranium price. That's one thing. The second thing is that uranium makes up less than 5% of the cost to run a nuclear power plant. So the end users are not price sensitive, and it doesn't have the same limiting factors as oil does. When the price of oil goes over $100 a barrel, or last time it did, it can become an impediment to economic activity. Uranium is almost the polar opposite of that. And that's because a very little amount of uranium can generate a humongous amount of energy. The barrel equivalence is 3 barrels of uranium can generate the same amount of energy as over 100,000 barrels of oil. And so fast forwarding, next point is really how global nuclear power is becoming. Today there are reactors operating in over 30 countries. And so and the number of reactors globally being built at over 50 is a greater growth profile than what we hit in 2006. So in 2006, nuclear power was actually a bit of a buzzword. The buzzword was nuclear renaissance. Today, it's a reality. It's not about buzzwords. There are reactors being built to meet the increasing energy needs of the world's growing population. And finally, again, the move towards e-mobility with electric vehicles, hybrid vehicles, et cetera, all of that just puts more demand for electricity demand that we didn't have in 2006. Finally, in 2006, we had in front of us the expiry of a Cold War era agreement between US and Russia called the Highly Enriched Uranium Treaty that dated back to the early 90s, that involved dismantling Soviet era warheads and taking uranium from warheads that were highly enriched, blending them down to low enriched and selling that into the market. That was a deal that went on for close to 30 years. That was the equivalence of being the world's largest uranium mine. That ended in 2013. So in 2006, you still had that the effect of that uranium coming from Soviet-era warheads in the market. And today, you don't have that anymore. That deal's done. It's behind us and ended in late 2013. So the supply-demand fundamentals are so much stronger because the secondary supply and the dismantling of Cold War era, all of those dynamics are behind us. It's been digested in the system. So the only way to really meet the increasing demand for uranium is through mining more uranium. And we can't mine more uranium at $35 when most uranium mines in the world are losing money at these prices and are being shut down. The biggest uranium mine in the world, McArthur River, was shut down 2 years ago. So, these are not second-tier, third-tier mines being shut down. These are first-tier mines. And all of this, to me, is what makes the argument for why the upcoming run in uranium and the upcoming bull market in uranium will be far greater than anything we've witnessed before, most likely including that of what we saw in 2007 timeframe.
Yeah, I sure am excited to see how this one unfolds. And obviously, you mentioned a lot of the political things that go on in the market. So not the easiest thing to dig into just as a beginner. Although folks would like to get more information, you actually do have Uranium Energy Corporation. Can you just tell them how they can find that website, and if they have questions, would like to know more, how they can contact you?
Yeah, just go to uraniumenergy.com, contact us. We've got incredible depth on the team, including Scott Melby, who's the Executive Vice President of UEC and 35 years in the uranium business with all the major producers, including the largest producer in the world, which is Kazatomprom out of the country of Kazakhstan. And that's a whole other discussion about why there's too much concentration of production in one country, and that presents its own geopolitical risk and, again, more upside exposure. But to answer your question, uraniumenergy.com. We've got a team and a company that's been added with uranium energy for 15 years, and members of our team that have spent multiple decades in the uranium business and are a great source of information about the commodity, about the market, and about uranium energy and what we're doing as a producer of uranium in the United States at a time where there's zero uranium mining in the US, and the US is the world's largest consumer of uranium. And Chris, the same way that it's not a good idea to be importing all of our masks and ventilators and pharmaceuticals, I don't think it's a good idea to be importing 100% of US uranium requirements. Domestic supply is so important now. Domestic supply chains are so important. That's probably a discussion for a whole other interview. But you called it gold and uranium are dear to me, the two yellow metals. You see the gold mining banner behind me there. I love gold and uranium. And they were both in a prolonged bear market. One of them has come out of that prolonged bear market. That's gold. The other one hasn't yet, but it will. And we're going to have a lot of fun with the two yellow metals.
Yeah, I certainly agree with you there. You would think it's not the ideal setup. Maybe after Uranium Energy Corporation and gold mining, we could send you to take care of the Fed or be the next president. If only they ran things the way that you run a company. So I appreciate you joining us today. And you did mention gold mining as well, which fortunately Amir was kind enough to record another quick talk about that where you can hear, especially if you're looking for leverage, if you think the one thing you can count on out of government is that they're going to print more money and the gold price is going to go up, well, then you will want to check out the video that is coming your way now.